March 15th, 2026. Mark this date in your calendar. Circle it in red. Because in exactly 74 days, the global silver market will face a mathematical crisis that could send prices from today, $72 to $120 per ounce, in a matter of hours. Not weeks, not months, hours. What most people don't understand is that we're not just watching another commodity rally. We're witnessing the final countdown to the first genuine supply apocalypse in modern precious metals history. And the epicenter isn't in some distant country you've never heard of. It's happening right here, right now, in the mines that supply nearly 60% of the world's silver. Here's what should keep you awake at night. By March 15th, 3 separate supply catastrophes will converge simultaneously. Latin American mine closures will hit critical mass. Industrial demand from the AI revolution will reach peak intensity, and the mathematical deficit that's been building for 5 consecutive years will finally break the system. When that happens, silver won't just rise to $120. It will gap there overnight, leaving anyone who waited for a confirmation paying triple digits for metal they could have bought for $72 today. Let me show you exactly what's coming, why March 15th is the trigger date, and why the next 74 days represent the last chance to position before the supply crisis hits with full force. Here's the brutal truth nobody wants to discuss. The backbone of global silver production is breaking, not metaphorically, literally. The mines that have fed the world's silver hunger for decades are reaching the end of their economic lives, and there's nothing to replace them. Start with Mexico, the planet's silver powerhouse. For decades, Mexico has been the undisputed king, pumping out 25% of global supply. But that empire is crumbling before our eyes. Production has collapsed by double digits year after year, not because of labor strikes or political chaos, but because the earth is running out of economically viable silver. The San Julian mine in Chihuahua State tells the whole story. This isn't some small-time operation. This is one of Mexico's flagship silver producers, a massive industrial complex that's been feeding global supply for years. By 2027, it's done. Finished. The ore grades have fallen so low that continuing operations would lose money at any realistic silver price. But here's what makes this terrifying. San Julian isn't unique. It's the canary in the coal mine. Across Mexico, the same story repeats. Older mines hitting depletion, lower ore grades making extraction uneconomical, and absolutely nothing in the development pipeline to replace what's being lost. When a mine produces 1,000 tons annually and shuts down, that metal doesn't magically appear somewhere else. It's gone, forever. And Mexico is losing multiple San Julians every year. Move south to Peru, Bolivia, and Chile. Together, these 3 countries control another third of global silver supply, and they're all facing the same nightmare: declining ore grades, rising extraction costs, and political instability that's scaring away the massive capital investments needed to develop new deposits. Peru's mining sector is under constant pressure from environmental protests and regulatory uncertainty. Bolivia's political system swings between extremes, making long-term mining investments a gamble few companies are willing to take. Chile's copper mines, which produce silver as a byproduct, are dealing with water shortages and aging infrastructure. This isn't temporary. This isn't cyclical. This is geological reality meeting economic mathematics. The easy silver has been mined. What remains is deeper, lower grade, and exponentially more expensive to extract. The numbers are stark. Latin American silver production has fallen 15% in 2 years. At current depletion rates, total regional output could drop another 20% by 2027. That would remove nearly 150 million ounces from global supply. In a market that already runs a deficit, that kind of supply loss is apocalyptic. And here's the kicker: it's accelerating. Every month that passes without major new discoveries or massive capital investments makes the cliff steeper. By March 15th, the full scope of this supply destruction will be undeniable. The market will wake up to the fact that the silver shortage isn't coming, it's here. While supply collapses, demand is exploding, and the biggest driver isn't traditional jewelry or investment. It's the artificial intelligence revolution that's reshaping the global economy. Every AI data center, every high-performance chip, every next-generation server requires silver, not as decoration, as critical infrastructure. Silver's unique electrical conductivity properties make it irreplaceable in the circuits that power artificial intelligence. There is no substitute, no alternative material, no workaround. Here's what most people miss. The AI build-out isn't gradual, it's exponential. Companies aren't just adding a few servers here and there, they're constructing massive data center complexes that require millions of ounces of silver for their electrical systems. The numbers are staggering. Oxford Economics projects that data center construction in the US alone will increase 65% by 2031. And that's not global, that's just America. China's AI infrastructure spending makes US numbers look conservative. Europe is racing to catch up. Every major economy is building AI capacity as fast as physically possible. Each new data center requires about 50,000 ounces of silver for its electrical systems. That's $3.6 million worth of silver at today's prices. And these facilities aren't one-time builds. They require constant upgrades, expansions, and component replacements as AI technology advances. But data centers are just the beginning. The electric vehicle revolution is consuming silver at unprecedented rates. Every EV uses 3 times more silver than traditional cars. Tesla alone requires millions of ounces annually just for current production. Scale that across every automaker transitioning to electric, and you're looking at industrial demand that dwarfs historical consumption. Solar panels represent another massive demand source. Each panel requires 20 to 40 grams of silver paste for its photovoltaic cells. With governments worldwide pushing aggressive renewable energy targets, solar installation rates are accelerating exponentially. The International Energy Agency projects solar capacity will triple by 2030. That's hundreds of millions of additional ounces of annual silver consumption. Add it all up, AI infrastructure, electric vehicles, renewable energy, 5G networks, medical devices, consumer electronics. Industrial silver demand is growing at 8 to 12% annually across multiple sectors simultaneously. This isn't cyclical demand that rises and falls with economic cycles. This is a structural transformation of the global economy toward technologies that require silver to function. Now combine collapsing supply with exploding demand, and you get a mathematical equation that ends only one way: exponential price increases. Global silver production is around 835 million ounces annually and declining. Global consumption is 1.2 billion ounces annually and accelerating. That leaves an annual deficit of 365 million ounces, and it's widening. For 5 consecutive years, the world has consumed more silver than it produced. That deficit gets filled by above-ground stockpiles, existing inventory that was accumulated during previous years of surplus. But those stockpiles are now critically low. Exchange inventories tell the story. COMEX registered silver, the metal available for immediate delivery, has fallen from 200 million ounces in 2020 to under 50 million today. That's a 75% collapse in deliverable supply in just a few years. London metal exchange warehouses show similar patterns. Metal is flowing out, but nothing is flowing in. Shanghai futures exchange inventories are at multi-year lows. Every major exchange is showing the same trend: a relentless drain with no replenishment. Here's why this is so critical. Industrial procurement cycles are coming to a head. Companies that have been delaying silver purchases, hoping for lower prices, will be forced to act. Their production schedules won't wait. Their customer commitments won't wait. They'll have to pay whatever it takes to secure supply. At current inventory levels, there simply isn't enough physical metal available to satisfy this demand at anything close to today's prices. Imagine 50 companies simultaneously trying to buy 1 million ounces each, when the total available inventory is only 45 million ounces. Basic supply and demand economics takes over. Prices don't rise gradually in supply shortage situations. They gap higher violently as buyers bid against each other for scarce physical metal. $72 could become $85 in a day. 85 could become 100 in hours. 100 could become 120 when the last buyer realizes there's no more metal at lower prices. What makes this crisis even worse is the massive disconnect between paper silver trading and the physical silver reality. Most silver trading happens through futures contracts, ETFs, and derivatives that have little connection to actual metal. Traders buy and sell paper contracts representing millions of ounces of silver that doesn't exist in deliverable form. The COMEX trades contracts for 500 million ounces of silver every single week, but their total registered inventory is only 50 million ounces. That's a 10-to-1 paper-to-physical leverage. This system works fine when everyone's playing the paper game. Contracts get rolled over, positions get cash settled, and the fiction continues that there's always metal available if someone actually wants delivery. But what happens when they do? We might just be about to find out. But when industrial users start demanding physical delivery en masse, the system breaks. You can't deliver contracts. You can't ship promises. You can't put paper silver into a solar panel manufacturing line. March 15th represents the collision between paper fantasy and physical reality. Industrial buyers don't want futures contracts. They want metal in warehouses ready for production. And when they discover there isn't enough physical metal to satisfy their needs, they'll bid prices to whatever level necessary to secure supply. This is when the paper market becomes irrelevant. Shanghai physical premiums already trade $5 to $8 over COMEX futures. Those premiums will explode to $20, $30, even $50 over paper prices when the physical shortage becomes undeniable. This isn't the first time silver markets have faced supply crises, but it might be the most severe because this time the shortage is permanent. Previous silver squeezes were caused by financial speculation. The Hunt brothers in 1980 tried to corner the market through leveraged futures buying. When their financing collapsed, so did silver prices. The 2011 rally was driven by investment demand during the European debt crisis. When the crisis passed, investment buying dried up and prices fell. But 2026 is different. This shortage isn't driven by speculation or investment flows. It's driven by a structural supply decline meeting structural demand growth. You can't manipulate geological depletion. You can't talk industrial users out of needing silver for production. When the Hunt brothers were forced to sell, their silver flooded back into the market. When 2011 investors lost interest, their ETF holdings got liquidated. But when Mexico's mines reach depletion, that silver is gone forever. When AI data centers consume silver in their electrical systems, it never comes back to the market. This is permanent supply destruction meeting permanent demand increases. The only way this resolves is through much higher prices that ration demand and potentially incentivize new supply development. But new mines take 7 to 10 years to develop under ideal conditions. We don't have 7 to 10 years. Governments are waking up to silver's strategic importance, but their solutions will make the shortage worse, not better. The U.S. designation of silver as a critical mineral acknowledges its importance to national security. Defense systems, renewable energy infrastructure, and communications networks all depend on silver. But government stockpiling adds to demand rather than supply. Strategic reserves must be filled. Defense contractors need guaranteed silver supplies. Government demand is typically price insensitive because national security trumps cost considerations. China has been quietly accumulating silver through state-controlled entities for years. Their Belt and Road infrastructure projects require massive amounts of silver for electrical systems. Their domestic manufacturing depends on secure silver supplies. Chinese government buying adds hundreds of millions of ounces to annual demand. Russia, Iran, and other nations facing Western sanctions view silver as a way to diversify away from dollar-dependent assets. Central bank buying of precious metals has accelerated dramatically since 2022. Sanctions demonstrated the weaponization of dollar-based financial systems. This government and central bank demand is new, structural, and ongoing. It represents an additional layer of purchasing power that didn't exist during previous silver market cycles. So why March 15th specifically? 3 critical factors converge on that date. First, Q1 industrial procurement deadlines. Most major manufacturers operate on quarterly purchasing cycles. Q1 silver needs must be secured by mid-March to ensure Q2 production schedules. Companies can't wait longer without risking supply chain disruptions. Second, mining company quarterly reports. Q1 production numbers from major Latin American producers will confirm the supply decline that's been building throughout 2025. When markets see the actual production data, the supply crisis becomes undeniable. Third, Federal Reserve policy clarity. The Fed's March meeting will provide definitive guidance on 2026 monetary policy. If rates decline as expected, dollar weakness will amplify commodity price increases. If rates hold steady, it signals economic strength that increases industrial silver demand. Any of these factors alone could trigger significant price movements. All 3 converging on the same timeline creates perfect storm conditions for explosive price action. So why a $120 price target? Because that's what the mathematics demand. At current supply and demand trajectories, silver markets need prices high enough to ration industrial demand and potentially stimulate new supply development. $120 silver makes some marginal industrial applications uneconomical, reducing consumption by perhaps 10–15%. It makes previously uneconomical mining projects potentially viable, possibly adding 5 to 10% to global supply over 3 to 5 years. It encourages recycling and substitution where technically possible. But even $120 might not be enough if supply declines accelerate or AI demand grows faster than projected. Some analysts privately discuss $150 to $200 silver as necessary to balance deeply undersupplied markets. Historical context supports these projections. Adjusted for inflation, silver's 1980 peak of $50 equals roughly $180 in today's currency. Silver hit those levels during a speculative bubble with no underlying supply shortage. Today's situation involves genuine physical shortage with structural industrial demand. $120 isn't the target. It's the minimum required to restore market balance under current conditions. So who wins and who loses in this scenario? Physical silver holders win massively. Anyone holding actual metal benefits from every dollar of price appreciation. Mining company shareholders win if they survive the production challenges and capital requirements of developing new projects. Countries with domestic silver production gain strategic advantages and export revenues. Mexico, despite declining production, still benefits from higher prices on remaining output. Industrial users lose competitiveness. Higher silver costs get passed through to consumers as higher prices for electronics, vehicles, and renewable energy systems. The green energy transition becomes more expensive. Developing nations dependent on silver imports face balance of payments pressures. Higher commodity costs strain currencies and economic growth. But the biggest losers are those who wait for confirmation. By the time mainstream media acknowledges the supply crisis, physical premiums will be 20-30 over spot prices. Available metal will be scarce at any price, the final 74 days. March 15th is 74 days away. 74 days to position before the supply crisis hits with full force. 74 days before industrial panic buying begins. 74 days before the mathematical deficit breaks the system. Every day that passes, another 2 million ounces gets consumed permanently by industrial users. Every week, mining production falls further behind demand. Every month, the hole gets deeper. The smart money isn't waiting for $120 silver to buy. They're accumulating now at $72 before the scramble begins. They understand that supply shortages don't announce themselves politely. They arrive suddenly, violently, and leave unprepared participants wondering what happened. You have 74 days. 74 days to decide whether you believe mathematics or hope. 74 days to position before the crowd figures out what's coming. 74 days before the March 2026 supply crisis changes silver markets forever. The countdown has begun. The question isn't whether silver hits $120 by March 15th. The question is whether you'll be positioned when it does. This analysis is for educational purposes only. Commodity investing carries substantial risk. Past performance doesn't guarantee future results. Consider all factors and consult qualified professionals before making investment decisions. Thanks for watching, and be sure to subscribe for more insights.